Spotting and outlining the market structure along with its vital components is the foundational move that every trader needs to master on their path toward consistent success and profitability. A major reason many traders experience setbacks is due to their inability to effectively recognize and interpret the market structure. In today's episode, we'll break down both the basic and advanced principles of market structure that are crucial for traders to grasp and implement throughout their trading journey. We'll also reveal important methods and insights for mapping market structure, giving you a competitive edge in your analysis. Make sure to watch the full video attentively until the very end and take notes for a deeper, more complete understanding. So traders, if this is the type of content that helps you grow, give this video a like to show some love, and don't forget to subscribe to the channel if you're new. Welcome back, traders. Let's dive right into the general behavior of market structure. The driving forces behind price action can be narrowed down to two core elements that repeatedly dictate directional movement: trending, consisting of both uptrends and downtrends, and the consolidation phase, such as a ranging or sideways market. Think of it like a constant cycle where price moves through downtrends, uptrends, and consolidation zones that gather liquidity and institutional positions. Typically, price must consolidate between directional moves, whether transitioning from an uptrend to a downtrend or the other way around. The very first thing to ask yourself when opening your charts is whether the current market condition reflects an uptrend, a downtrend, or a consolidation phase. This is critical for building a reliable market outlook. Let's start with a basic overview of market structures and then move into the essential elements of advanced market structures. Picture a market structure that illustrates a textbook uptrend. I call this type of structure ideal, because it's uncommon to see an uptrend in the real market that follows this exact pattern. Price action usually doesn't unfold with such perfection. However, to better grasp the concept of an uptrend, we'll quickly examine this ideal structure before transitioning to a more realistic version that's frequently observed in live markets. In a typical uptrend, price continuously creates higher highs along with higher lows. It generally pushes above previous highs while protecting the lows. An uptrend concludes once price breaks below a key major low. For instance, to sustain an upward move, it's vital that price holds above this significant low. Each time price pushes beyond a major high, it triggers a break of structure, boss, and forms a demand zone related to that boss wave. Being able to accurately identify valid major highs and lows is essential, as it helps us spot cues for potential trend reversals or continuation setups. Failing to recognize these key areas increases the risk of getting trapped and executing trades against the prevailing market direction. The same principles apply when analyzing a bearish scenario. In a downtrend, price action steadily forms a sequence of lower lows and lower highs. In this setup, price typically breaks past prior lows while holding the previous highs. Now, let's move forward and take a closer look at the characteristics of a more realistic market structure. This illustrates the more practical uptrend structure that traders frequently encounter in the market. Now, let's walk through a situation where price breaks above a previous high. At this point, a critical question surfaces: how do we pinpoint valid major highs and lows? To answer this, observe the left-hand side of the structure. It's evident that price moved upward until it started to pull back. The peak reached right before this retracement started is labeled as the major high. Likewise, the lowest point of the bullish leg that launched the upward drive, ultimately leading to the break of structure and the formation of a new high, is identified as the major low. These two price levels define the primary external structure, while all formations occurring within this range are categorized as internal structure. When price pushes above the major high, forming a break of structure, boss, it indicates trend continuation. Conversely, if price falls beneath the major low, this should be taken as a trend reversal indicator. The detailed internal price action within this external boundary is not critical, as long as price respects the latest major low. As long as this condition holds, the market is considered to be in a bullish phase. Now that we've clarified the latest external structure points, they represent the current area of focus and the present trading range. As we notice, price has entered a retracement stage, producing a sequence of internal formations, primarily with bearish characteristics. Eventually, after establishing a bullish internal realignment, price moves upward and breaches the recent major high, setting a new high and a new low. This new major low is derived from an internal low located at the far end of the move. It qualifies as a major low because it's the last low formed before price initiated the upward swing that resulted in the break of structure. You may be wondering why this other low structure isn't classified as major. The reasoning is that the low at the extreme is the final and lowest point prior to the start of the bullish move. This specific low is vital, as it acts as the anchor low that launched the bullish momentum and the break of structure. Now, let's transition into the bearish setup, which, fundamentally, mirrors the same logic. In a bullish scenario that transitions into a bearish wave, the initial break of structure, BOS, occurs when price moves decisively below a previously established support level. This action creates a major low, marking the lowest point reached following the BOS. Together, the most recent major high and this new major low form what we refer to as the external structure. Any price action that develops within this range is considered internal structure. If the price breaks below the major low, it confirms a continuation of the bearish trend. However, if price rallies above the previous major high, this should be interpreted as a potential trend reversal signal. To simplify, as long as the price remains below the most recent major high, the market is considered to be in a bearish phase, regardless of the internal highs and lows that may form within the range. During a retracement, price often forms a series of internal highs and lows. In the scenario discussed, the price eventually dropped again and broke through the most recent major low, establishing another bearish BOS. The internal high that formed at the extreme right before this sharp bearish move is now classified as the newly generated major high, as it marks the last significant internal high before the bearish momentum resumed. Following this, the price retraced once again, forming a new major low. As further internal structures developed within the range, price continued pushing lower, confirming a series of lower highs and lower lows, consistent with a sustained bearish trend. This brings us to a critical concept in market structure, the break of structure, BOS. You've likely encountered BOS in various trading tutorials, market structure breakdowns, or strategy guides. While BOS is often simplified as a price breaking above a previous high in bullish contexts, the reality is more nuanced. To accurately identify a valid BOS, we must follow specific rules and observe key structural points. In the bearish scenario, we observe the start of a downward wave that causes a break of structure. Additionally, we identify a major low that marks the lowest point price reached after that break occurred. These two levels, the major high and the major low, define our external structure, while all formations within this range are treated as internal structures. If the price pushes below the major low, resulting in a break of structure to the downside, it indicates a continuation of the bearish trend, just as we see illustrated here. On the other hand, if price climbs above the major high, it should be viewed as a signal for potential trend reversal. To put it simply, the behavior of price within these outer structure points is not significant as long as price remains beneath the latest major high, reinforcing the bearish sentiment. As the price corrected upward, it created a number of internal highs and lows within the established trading range. Eventually, price resumed its downward path and broke the most recent major low. At this point, the internal high at the far edge now becomes our newly established major high. This is because it's the last internal high formed before the price started its strong bearish drop that led to a break of structure. Afterward, price pulled back again, generating another major low. Then, following the development of several internal formations, the price continued its bearish movement, forming a succession of lower lows and lower highs. Now, we shift our focus to a fundamental concept in market structure analysis, break of structure, BOS. You've probably come across BOS in different trading lessons, market structure walkthroughs, or trading manuals. Typically, in a bullish trend, BOS is loosely defined as a situation where price breaks a previous high. However, in practical trading, there are certain criteria and important nuances that must be followed to confirm a legitimate break of structure. Now let's dive into the specifics, the rules and key points that define a valid break of structure, BOS. A BOS is considered valid only when the price breaks and closes above the most recent higher high with the body of a candle. This confirmation is valid even if price reverses quickly afterward. In this case, a new major high and major low are established, forming a new trading range. However, if price only breaks the high with a wick or shadow, and the candle body closes back below the high, without the next candle's wick exceeding the first, we do not treat it as a valid BOS. Instead, that movement is considered an internal fluctuation within the existing trading range. To confirm a trend reversal or change of character, CHOCH, In such a case, we wait for price to break the major low at the extreme, not just an internal high. Now, consider a different situation. Price breaks the high with a wick, and the first candle closes below the high's range. But then, the next candle's wick exceeds the first candle's wick. In this case, it's acceptable to treat this as a valid bullish boss. We now have a new major high and major low, forming the updated external structure. The internal activity between this new high and low doesn't affect the bullish outlook as long as price remains above the newly formed major low. Only when price closes below this low with conviction do we consider a valid CHOCH or trend reversal. Bearish scenario. The same principles apply in reverse. In a bearish market, a valid boss occurs when price breaks and closes below the most recent lower low with the body of a candle. If the price later breaks the most recent major high to the upside, this is viewed as a trend reversal, signaling that buyers are regaining control. If price breaks the recent low with a wick, but the candle body closes back above the low, and the next candle's wick does not exceed the first, this is not a valid boss. To confirm a true bearish break, price must close below the low with a full body candle. Conversely, if the next candle's wick surpasses the first and closes below the low, we treat it as a valid bearish boss. Following this, we update our major high and major low accordingly. As long as price remains below the newly established major high, the market is still considered bearish. Only a clean break above this major high confirms a trend reversal or significant change of character. Having explored both bullish and bearish boss patterns in detail, you should now have a strong foundational understanding of how to identify and confirm valid breaks of structure in different market conditions. Let's now explore another critical component of market structure, the change of character, CHOCH. To accurately identify a valid change of character, the first step is determining the overall market direction, whether it's trending upward or downward. Once the trend is established, the next step is to mark valid break of structures, BOSS, on your chart. Up triangle bullish scenario breakdown. In a bullish trend, price typically forms a series of valid bullish BOSS. The low and high formed during the first BOSS define your major structures, while all other price action between them is considered internal structure. Change of character patterns can be divided into two types. CHOCH occurs when price breaks an internal low. Major CHOCH happens when price breaks a major low. A minor CHOCH alone is not enough to confirm a market reversal. This is a common mistake among novice traders. For example, price may break an internal low, prompting some traders to assume the uptrend has ended. They go short and place their stop loss just above the internal high. But often, the market simply makes a small retracement, then resumes its bullish trend, stopping them out. The reason? The major low was never broken. The retracement was part of the trend, not a reversal. Checkmark confirming a valid change of character. To confirm a valid market structure shift, you need to wait for price to break and close below the last major low that led to the bullish BOSS. Only then can we consider it a major CHOCH and a high probability signal of a potential reversal. It's important to emphasize, in a bullish market, a CHOCH is only valid if price closes below the last major low with the body of a candle. If price breaks that level with just a long wick or shadow, but closes within the low's range, the CHOCH is not valid. Down triangle bearish scenario breakdown. The same logic applies in a bearish market. For a valid bullish reversal, i.e., change of character, price must break and close above the recent major high with a candle body. A wick or shadow alone is not sufficient. That's a wrap, traders. We hope you found this video insightful and practical for your trading journey. Don't forget to subscribe and turn on notifications so you never miss our next update. Have questions or topics you'd like us to cover next? Drop a comment below. Your feedback drives our content. Thanks for watching, and we'll see you in the next video.